Thank you for tuning into the Buyer's Guide podcast, where we talk all things property and finance. My name is Peter Mastriani, the founder of the Buyer's Guide, which has been established to really help as many people as possible buy their own home through to building a property portfolio to secure their financial future. In today's cast, we are going to discuss lenders' mortgage insurance and mortgage protection insurance, what they are, and the associated costs. So let's get to it. When you're assessed for a home loan, a number of factors will be taken into account. And one of the more important variables is the loan to value ratio, or the LVR. Now, it's pretty important because it's a measure of the amount of money that is going to be borrowed against the actual value of the property. Now, there are home loan products available that will virtually allow you to borrow almost up to 100% of the property value. Now, strings are going to be attached in these situations and they are viewed as pretty high risk. But look, it's not unheard of for people to secure finance at 95% LVR or, higher than 90% LVRs. Now, as a rule of thumb, 80% is the guideline for an LVR rate. Now, I say as a guideline because having a loan to value ratio below 80% means that you will avoid the lender's mortgage insurance or the LMI. Now, LMI protects the lender, not the borrower, meaning that a lender is going to charge you, an additional fee to insure themselves against the risk of the borrower, being you, defaulting on the loan. If you do default on the loan and the property is sold for a lesser value than the original sum borrowed, then the insurer is going to make up the difference, which will be payable to the bank. At this point in time, the insurer may also ask you, as the borrower, to repay this sum directly to them. So there's certainly a number of risks that could be involved with taking on a product like this, and lenders offer this product or offer lenders mortgage insurance because it essentially allows them to offer loans to a broader base of customers. Not everyone is going to be able to save a 20% deposit to get into their home. Now, this cost of lenders mortgage insurance can be paid up front or it can be capitalized in that it's added to the total cost of the loan. Now, lenders will apply for the LMI on behalf, and GST and stamp duty will also be added on top. Now, lender's mortgage insurance, the fees are going to vary and it's going to be dependent on the actual LVR rate and the actual size of the loan or the money being borrowed, meaning that it could be anywhere from 0.05 of a percent to 3% or more in some cases. Now, lender's mortgage insurance is, a burden cost that should be taken into consideration if you are intending to perhaps capitalize it on top of your loan, as it could be a way of shortcutting you to get into that home or that investment sooner. Now, mortgage protection insurance, or MPI, is often confused with lender's mortgage insurance, but the differentiator is that MPI protects you. So it's a product that in effect insures you in the event that something should prevent you from meeting your commitments. If you were to become ill or suffer an accident or something to that effect. Now, there's many different variations offered, and it is something to consider, particularly if you have family and dependents. So, in summary, borrowing 80% or more will be costly and at times potentially risky, particularly if you're borrowing in excess of 90% and pushing up closer to that 100% LVR. And look, consideration definitely needs to be given into it. So conversely, it certainly can be viewed as a necessary and worthwhile exercise in order to get into that home sooner. However, to avoid having to pay the lender's mortgage insurance, you would need to at least have a 20% deposit. Alternatives could be to ask a close family member to perhaps act as guarantor. And some professions are also precluded from having to pay lenders' mortgage insurance on the basis of their future earning potential. People within the medico industry, there's some exemptions that could apply there. So, how much does lenders' mortgage insurance actually cost? Now, I believe this is probably one of the most important questions that you will need to ask. Often, the difference in interest rates and fees between lenders can be quite nominal, I guess, to a certain extent, but the difference actually in the LMI can be really significant. Before proceeding, look, I would certainly get a few quotes prior to choosing your loan provider. And for an estimate on lenders' mortgage premiums, we can provide a bit of a brief outline at the end of this cast here. And these premiums, I have to point out, do change regularly. So the figures that I provide should really only be used as a guide only. Now, lenders' mortgage insurance, like I've mentioned, is going to be payable on pretty much all loans with a loan-to-value ratio above 80%. Now, the premium will be calculated by assessing two main variables, which is based on risk. So the first one being the actual loan amount, and the higher the loan, the higher the risk to the actual insurer. And the second aspect is the loan to value ratio. Again, the higher the LVR rate, the higher the perceived risk for the insurer. So if you are intending to purchase an investment property, or if you're self-employed, or perhaps you're applying for a low doc or low documentation loan, a whole new list of variables will be taken into consideration based around the various risk parameters. And again, this will usually attract a higher premium again because the insurer will perceive it to be a higher risk. Now, lenders are able to offer different premiums based on different scenarios because, premiums can be calculated in different ways, and the loan amount can fall into different bandings between lenders as well. Now, the insurers that the lenders use could at times offer better value for money, and sometimes they don't as well. And the lender may also apply a loading fee as well. Now, as I've mentioned, generally the insurance premium is capitalized, meaning that it's going to be added to the total cost of the loan. So while it can be capitalized, the LMI premium is usually capped to a final LVR of 97%. Now, some lenders are still doing a full 95% LVR plus LMI, but look, it's certainly it's definitely viewed as a more riskier product because it means that you could in fact be borrowing more than 100% of the actual property value. So to give you a very rough guide, say for example you had an LVR band that fell between just above 80 to 82%, then realistically, if you were borrowing, say, around 300,000, you'd be looking at paying about 0.5% of that total loan amount. If you're borrowing somewhere between 300 to 600,000, you'd probably be paying around 0.56%. If you were borrowing, say, 84 to 86%, look, it's getting closer to that percentage. If the loan amount was up to 300k, it would be 0.86%. And if it was between 300 to 600k, you'd be paying probably around about 1.05 to 1.06%. Now, if you're borrowing more than 90%, this is when the LMI premium starts to really jump. If you're borrowing, say, between 90 to 92%, you're probably looking at around about 2.03% on a loan amount up to 300k, and again it jumps again if you're borrowing between 300 to 600k at around about 2.65%. And if you're 94 to 95%, again you're looking at around about 2.64% if you're borrowing up to 300k, and over 3% if that borrowing is between 300 to 600k. And as I said, these premiums do change, and they generally go up. They haven't decreased for a significant period of time. There's two insurance providers that provide lenders mortgage insurance within the domestic marketplace, so they seem to have a bit of a duopoly there, and therefore have a bit of a control around the prices there. But look, if you would like to have a clearer picture on the potential expenses that would align to your new purchase, let's definitely have a chat. At the Buyer's Guide, we work with a whole range of different people to really help them decide when the time's going to be right to buy. And we'll also help you decide what type of lending structure is going to be most suitable for you as well. So that concludes the episode. So thank you for tuning in, and be sure to subscribe to stay up to date for our latest episodes. Bye bye.